Traders, welcome to the stops and targets section of the pullback strategy. So this section should be pretty easy to comprehend considering what you've learned so far in the course. And in order to complete this section, you will need a ATR indicator on your chart. This is an indicator that should already be there based on the previous lessons. But if you don't have it on there, just find that ATR indicator in your charting platform and go ahead and apply it to the chart, because we will be using that to place our stops for the pullback entry. Now we will quickly go over how we're going to be using that ATR in order to place those stop losses on the pullback strategy. And if you'd like, you can go ahead and write down the rules that are right here for our stop loss rules. So in order to place a stop loss, all of our stop losses are going to be above the previous swing high. So this would be the previous swing high of this entry. As you can see here on the chart, we have this pullback into an entry number 2 for the pullback strategy. This is something we discussed in the previous video, entry number 2 right here. And the reason this is an entry number 2 is because the market pulls all the way up to the 50 EMA and puts in our advanced engulfing entry with a 1, 2, 3 engulfing pattern. So that gives us our entry number 2. We would be entering the market at the close of that candle for entry number 2, and number 2 candle right here from our 1, 2, 3 advanced engulfing entry is going to be our swing high. So our stop loss is always going above the swing high. If we have an engulfing candle that's the swing high, which is the other way we can enter the market, let's say that this engulfing candle here had a wick that made it the swing high. If that was the case, our stop loss would go above that wick because that would be the swing high. The point of that is the fact that our stop loss is always going to go above the previous swing high. So we have the close of our candle, we enter the trade. Now how do we place our stop loss? Well, let's take a look at our rules right up here. For our stop loss rules, if the ATR of this candle, the entry candle, is over 20 but under 30, then our stop loss is going to be 20 pips above this swing high. So what does that mean? That means that if the ATR is between 20 and 30, if it's 20, 21, 22, so on, all the way up to 29, if we have a 29 pip ATR, we're using a 20 pip stop loss. So anything between 20 and 30 is going to be a 20 pip above the swing high stop loss. Now, if we have an ATR, and the way we figure out the ATR, guys, is hovering over the entry candle and looking right up here in the top left-hand corner, this number on our ATR indicator. So if we have an ATR that's over 30 but under 50, meaning anything between 30 and 50, from 31 all the way up to 49, we're going to be using a 30 pip stop. And that would be the case even for 30. So from 30 all the way to 49, we're going to be using a 30 pip stop loss. So if this ATR right here, instead of being 24, was 34, we would be using a 30 pip stop. Now, if the ATR of the entry candle is over 50 but under 100, this will be the case for some more volatile pairs on the 4-hour chart, which is the chart we're going to be trading, which is the time frame we'll be trading the pullback strategy on for the transition phase of this course. So we will have some pairs with an ATR above 50 but under 100. In that case, we'll be looking for a 50 pip stop loss above the swing high. And for the very rare occasion where we have over a 100 pip ATR on a 4-hour chart for a pair, we'll be using a 100 pip stop loss above the swing high. So hopefully that is pretty easy to comprehend. I don't feel like that's a very difficult concept. What we're doing is just looking at this ATR indicator up here to the top left-hand corner of the screen that we applied to the chart in the earlier lessons. And if that number is between 20 and 30, we're using a 20 pip stop. If that number is between 30 and 49, then we're using a 30 pip stop. If it's between 50 and 100, we're using a 50 pip stop. And anything over 100 is a 100 pip stop, all above the previous swing high. So go ahead and write those rules down. Again, it's a pretty simple concept, and taking targets is an even more simple concept. If you've already taken a look over here, you'll see that the target taking rules are a 1-to-1 risk reward based on a stop loss. So let's go ahead and place the trade. Again, target taking, very, very simple. We're just looking for a 1-to-1 risk reward after we place that stop loss. So let's take a look at a practical application of taking a trade based around this stop loss rule and target rule for the pullback strategy. Here on the chart, we have our entry number 2 here on the Aussie Canada. So what we would be doing is placing an entry at the close of this entry number 2. At that point, we hover over our entry candle. And if you're looking in the top left-hand side of the screen, right up here, while I hover over that, you'll see that the ATR for that candle is 24. With the ATR being 24, what does our stop loss need to be? Well, we know that if that number is anywhere between 20 and 30, we need a 20 pip stop loss above our swing high right here. So what do? We go ahead and put our position tool on here, which can be found in TradingView right here in this section to the left. Click that long position, short position. We would be using a short position, which I already have applied to the chart. So that short position tool we'd go ahead and place at the close of our candle if back testing or if doing live trading. Once that candle closed, we'd place that. We would go to the swing high with the stop loss tool, which is 26 pips. You can see that right here. We have 26 pips up to the swing high. All we do now is add 20 pips to that, which would make our stop loss 46 pips. And considering our target is just based on a 1-to-1 risk reward that is based on our stop loss, we know that if we have a 46 pip stop loss, we're also going to need 46 pips for our target. And this is how we're going to be placing stops and targets for the pullback entry in the transition phase of the course. Now, there will be a way to take multiple targets using this and extended targets to improve profitability, but for now we're keeping things extremely simple, and throughout the transition phase of the course until you become profitable using this strategy with just a 1-to-1 risk reward based on the stop loss. I don't want you going any further or trying to take multiple targets. That's going to be way too confusing at first if you're not profitable already. So go ahead and get profitable using it this way. And the reason that this can be profitable just using a 1-to-1 risk reward is because based on the back testing performance and the live performance in my trading, once we create this entire trading plan around the pullback strategy, utilizing this way of placing stops and targets, utilizing all the things we've learned about structure analysis, trend, the pullback strategy itself, and the entry patterns, utilizing all of that and creating a trading plan around that, plus the specific pairs we're going to talk about later on in the course, give more than a 50% chance of winning. Meaning that if we have a 60% chance of winning, and we only win at a 1-to-1 risk reward, we're still going to be ahead and we're still going to have an advantage over the market. And that's what we're trying to implement here using this pullback strategy, is getting an advantage over the market. So here, as you can see, a successful trade using that 1-to-1 risk reward and the stop loss based on our stop loss rules. Let's take a look at another example. Instead of entry reason number 2, let's take a look at an example with entry reason number 1. So right here on the chart, you can see we have an example of entry reason number 1. Hopefully you were already able to spot that, but this right here is going to be a swing high engulfing candle, which is one of the ways we can enter the market. So if this was the case, how do we tell what our stops and targets should be on this specific trade? We have our rules met. We have a lower low, market pushing down, breaking into a new low right here, also pushing back up all the way to our 50 EMA and putting in swing high engulfing candle, advanced engulfing candle we talked about earlier in the course. So with that being the case, what we would do is take our position tool, the short position tool that we talked about, we would place it at the close of that candle or at our entry, make that a bit smaller. Then we just hover over this candle. Looking up to the left, you can see that that has a 24 pip ATR as well, which means if we're between 20 and 30, we need a 20 pip stop loss. So we'll head down to the swing high, which is the swing high engulfing candle. So that means that swing high would be what we need to place stops above. That's giving us a 20 pip all the way up to the high, which means we add 20 to that and we end up with a 40 pip stop loss. And in order to place targets, we just base that on a 1-to-1 risk reward based around that stop loss at 40 pips, and we have our trade set up right there, which obviously went on to hit targets. So we'll take a look at one more example of this, and then we'll go ahead and move on to the next section of the course. This is not a very complicated concept, but I do want to make sure you completely understand it before we move forward. So let's go ahead and go to one more example on the charts, and then we'll move ahead in the course. Okay guys, so here we have a valid entry number 1, right? We have a market pushing down, breaking into new lows, pulling back, and creating that 1, 2, 3 being the engulfing candle right here. This is the close of the candle, which is where we would put our entry. Let's go ahead and put our entry there and figure out our stops and targets. So we have our entry tool. We put it right down there at the close of the candle. We measure up to our swing high, which would be right here, this previous little green candle. Our swing high gives us about 18 pips. We hover over our entry candle, look to the top left. We have a 23 pip ATR. If the ATR is over 20 but under 30, then the stop loss is 20 pips. So we have 18 plus 20, which is 38 pips stop loss. And the number I'm looking at is right here in order to find that. As you can see right here, we have 38 pips. Once I have my stop loss, I know how to go ahead and push up our target taking tool to give me a 1-to-1 risk reward. And at that point, my trade is set up. And guys, we'll take a look at one more example. I'm going to go to a pair with a higher ATR just to show you guys an example of that. And something important to note that I just now realized is that if we have a 30 pip ATR, then the stop loss will be 30 pips. If we have a 50 pip ATR, then the stop loss will be 50 pips. So this should really be over 20 but under 29. This should be over 30 but under 49, because if we have 50 pip stop loss, we will be using a 50 pip stop loss. But now we'll go ahead and move on to a higher ATR pair and take a look at how to place stops based around that. Okay guys, so here on the charts, looking at the far right edge of the screen, there's a good example of a entry reason number one for the pullback strategy. We have a swing low candle that is in fact an engulfing candle considering the previous candle. Now, in this case, how would we place our entry? We would take our entry tool for a long position, place it at the close of that candle. We would hover over that entry candle, which is what we're doing now. As you can see, if you look in the top left, we have a 64 pip ATR. What does that mean? Well, if we have anything over 50 but under 100, then our stop loss is going to be 50 pips below the swing low. The swing low was the engulfing candle right here. So what we'll do is move down to that swing low once we get to a position where we can see. So we'll take that swing low, which is 64 pips, and we'll add 50, which is going to be a 115 pip stop loss. Now we know that we're looking for a 1-to-1 risk reward, so we need a 115 pip target as well. And now we have that 1-to-1 risk reward. Our entry is placed at the close of that engulfing candle, and this is the way our trade setup would look. That's how we would place the stops and targets. And as you can see, if we look left here, if we place a horizontal line, targets were barely hit, but targets were hit on this specific trade. So there's an example of placing stops on a pair with a higher ATR, and that's how we're going to be placing stops and targets for the pullback strategy. Hopefully that is all easy to understand for you. If not, make sure to go ahead and go back and rewatch the video. Make sure you take notes to make sure you're doing this correctly in real time, because things can get a bit confusing whenever you go to trading in real time on demo or on a live account. In the next sections, we'll actually be talking through how to backtest the strategy. We'll do some backtesting together. We'll build out a backtesting spreadsheet together. And ultimately, we'll be getting ready for you to create your own trading plan around the pullback strategies. So I'll see you guys in that next video.